We're just half an hour away from the open of Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne Man. Our top stories this morning. Asian stocks retreating as traders reassess the path forward for interest rates, with more Fed officials and Jamie Dimon warning lending costs will stay higher for longer. China's officials set to meet with state banks shortly to discuss aid for the property sector, including proposals to clear inventory. Country Garden, meanwhile, beginning a major legal battle against liquidation. And we are counting down to China's April activity data, expected to show modest signs of recovery as policymakers ramp up support. Happy Friday. We made it, but it is going to be a busy end of the week. I tell you that right now. You take a look at how stocks are doing. We're still set for that weekly drop when it comes to Asia. If in fact, you look at what happened overnight on Wall Street when you had U.S. as well as even the European, some of these indices came off some of those record highs here as we tried to assess what these rate cuts mean. When you're hearing this more Fed speak that, higher for longer, it might be here to stay. And you're still talking about a dollar, though, the dollar index set for a first monthly fall in 2024. That should bode well still for the month, I guess, for when it comes to risk assets. But you are seeing a bit of a downdrift here when it comes to equities in Japan, Korea, Australia. Keep in mind, though, I think it's the S&P, the NASDAQ, and Hang Seng still set for 4 weeks of gains this week as well. CSI 300, though, we might be snapping out of that for the first time in a while. Taiwan's coming online. Looks like we're seeing a slight bid here. Watching this, the tech earnings and the like here today after what we saw in the Golden Dragon Index. There you go. You saw basically earnings from Baidu and JD.com in some ways actually surprisingly beat when it comes to earnings. The revenue side might have slowed down a bit for Baidu. We'll talk about that a little bit later on as well. But the approach to the open is looking like this. So in China, you got a lot of things going on. So we have the activity data we talked about, property prices coming through. You have a state council meeting, which we'll talk about in a bit. And then there's this 30-year ultra long bond special bond sale that's happening today as well. So all of that encapsulating what we're seeing. We're set up for a higher open here today as well. We're watching that 30-year very closely as well at 258. It looks like there's a bit of a solid demand, according to some of the financial news and the local media saying about how much demand could we see from this bond auction here today, and 722.48 for the currency as well. So here's what the agenda is in store. I talked a little bit about this, right? So it's going to be busy. Property support. So anything that we hear from the state council meeting, China activity, home prices, special bond sale. You have Putin in China as well. There's an HSI review. And then we have to kind of look at the rest of the tech earnings that came through when it came to Baidu as well as JD.com. I want to bring in my anchor buddy this next 2 hours, our Chief North Asia correspondent, Stephen Engel. There's a lot going on.
It's a busy Friday.
Can't wrap my head around it yet.
Min Lo is going to be joining us, too, with the data dump for April from China. But again, the special sovereign bond sale, very interesting, only the fourth time in 26 years. I mean, back in 98, I've been around since, and I remember they had to recapitalize the big state banks. Then they basically fed into the Sovereign Wealth Fund in 2007. Then in 2020, they issued again these ultra long-term sovereign bonds for COVID measures and relief, and now this is the fourth time. So property is probably the end benefit there.
Yeah.
And we'll have to see. We'll dig into that with many of our guests, including Shuli Ren with her.
Especially if people are calculating, crunching the numbers, how much is going to cost to really absorb all this excess inventory in the housing market.
More pressure on the state banks, non-performing loans, more pressure at the local government level. Their debt crisis is still there, and their fiscal crisis is still there. So there's lots of things to figure out. Who's going to be shouldering the burden? And
who's going to be at the state council meeting later on today? If you look at the guest list, or at least the invitees,
financial officials, housing ministry,
local governments,
state banks.
What does that tell you?
Well,
it's a big group of people.
It'll be an interesting video conference, actually. They're bringing everybody in by video, by Zoom, okay? And who's going to get the loudest voice and who's going to be taking most of the pain, actually?
Yeah, and it seems like they're really putting this as a priority now when it comes to this property market, and really kind of emphasizing this new phase that we're seeing when it comes to the stimulus measures too, that downturn that we're seeing in housing. Let's talk a little more about the data dump. Usually that's our top story, and it still is. What we're expecting out of the April numbers here, analysts are expecting a slight increase compared to March. But are we still going to see this sort of two-speed economy? Let's bring in our China correspondent now, Min Lo. She joins us, her debut on the China Show. Welcome.
Thank you.
What should we be watching out for?
Well, the economy is looking set to come out of a lull as we head into the second quarter after those disappointing numbers in March. Industrial production is likely to take the lead. If you take a look on your screens, let's pull up the analyst estimates there. Industrial production, economists are looking at a 1 percentage point increase from March on the back of stronger exports. Retail sales, that's a number that we want to look closely at because, as you said, are we going to see finally a balanced recovery or that two-track recovery with industrial production and fixed asset investments racing ahead of consumption? And if you look at the May Day holidays data, we're still seeing, huge appetite for travel, but per capita spending still not breaking above pre-pandemic levels. So people still keeping a tight grip on their wallets. And if you look at the data as well for purchases of automobiles, housing appliances, demand still sluggish despite that government rollout of the trade-in program, trying to encourage businesses and households to upgrade their equipments. So mixed results there.
Miming, you're basically alluding to the fact that the domestic demand consumption is still weak. And these trade-in cash for clunkers for the cars hasn't really lifted yet.
Exactly.
The car sales. But right now, the growth and the momentum that we're seeing in China is really coming from top-down priority on manufacturing and investment. What's going to take? What are we seeing, though, on some of the consumption sides that could potentially lift that side of the equation?
Yeah, so consumption, as you said, especially property, that's a big drag on the economy now. If you look at April sales, down 45% still, despite the rollout of, a series of pro-growth signals with city after city saying that they are removing home buying curbs, and yet sentiment remains pessimistic, but we saw that in a scoop today that possibly we are looking at this big meeting of the government looking at buying back potentially millions of homes across the country. That's not going to, we're not going to see the effects of that yet in the April data, though, but we will see, however, fixed asset investments still seeing a resilient number there with the trickle-down effects from last year's issuance of that trillion yuan bond, sovereign bond, that is likely to go into investments, infrastructure investments right now.
All right, Min, thank you. Min Lo, there, our China correspondent, joining us here with a preview of that activity data still ahead. We're going to have BofA Securities sharing their latest China stock strategies and whether investors should chase this rally or sell the bounce. But first, we have the BSP Governor Eli Remolona saying that the Philippine Central Bank may cut its key interest rate by 50 basis points or so this year. He joins us exclusively after their policy decision yesterday, and we're counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. This is the China Show. Happy Friday. Well, the Philippine Central Bank kept its key rate unchanged at a 17-year high, but says it may pivot to cutting rates as early as August as price risks moderate. For more, joining us exclusively here is the governor himself, Eli Remolona. Governor, thank you so much for joining us, and you certainly have laid out the path of these rate cuts quite clearly here yesterday on this press conference. 25 basis points potentially in August and maybe 50 to end this year. It seems like you've struck a pretty less hawkish tone now. How do you think that's going to be impacting the peso and the currency moving forward?
Oh, that's right. Still hawkish, but less so than before. It may put pressure on the peso, but so far it hasn't. The peso opened at 57.53 this morning. That's only 7 centavos weaker than last night. So far it hasn't really affected the peso.
Okay. It seems like right now 58 seems to be that magic number people kind of bring up about whether the BSP would intervene. How far would you go in defending the currency?
Well, yesterday we didn't intervene at all. We were happy with the movement of the peso, but if there's stress, then we might come in. Stress means large offer sizes, high volatility, and then we might intervene.
You didn't intervene yesterday, but have you been intervening recently?
We have, yeah, in small amounts, not to really affect the value of the peso, more to to keep markets orderly, but not yesterday.
Okay. How are your foreign reserves? I mean, do you have enough in your coffers right now in case things get volatile throughout the year, especially if you're saying that you can actually cut rates ahead of the Fed?
We have ample reserves, so we're comfortable with the amount of reserves we have.
Well, Governor Stephen Engel here, is it a wait-and-see kind of approach right now as well on the possible intervention when we're seeing that maybe the Fed, though, will not cut until December at the earliest, according to some of the expectations? Is this a strong dollar story right now that you're battling against with the peso?
Yes, it's been a strong dollar all along, broadly strong dollar for the past several weeks. So we don't feel obliged to intervene, but we want to keep the market orderly.
Governor, also, we heard some comments from you saying that perhaps some of these maritime incidents off the Philippines in the South China Sea with China have had an impact on the peso.
Yes.
What are you seeing, the direct correlation there?
Well, any incident seems to affect the peso a bit. So far, not so sharply. But recently, none at all. The incidents have not affected the peso.
Okay. Governor, is there a concern in any way of the pass-through of a weaker peso to inflation dynamics now? Is that a concern to you in any way?
The pass-through has been very small because the movements of the peso have been small. But that's not to say that if the peso weakens sharply, the pass-through may be significant. But so far, it's been small. It's been there, but small.
What do you think you need to see to warrant that cut in August, Governor Remolona? Are the inflation dynamics? Do you think inflation will still remain in target of that 2 to 4%? Also, domestic demand, can that continue to soften, or are there upside risks to both of those scenarios?
There are upside risks to both scenarios, but so far the peso, the inflation rate has been looking good. It's been trending down, and output growth has remained intact. So those are pieces of good news for us, which makes us more confident about possibly easing in the second half of this year.
You also mentioned about that triple R cut, Governor. Maybe tell us a little bit more about the thinking that you can actually start discussing this triple R cut once you do start easing.
Yes,
is this going to be something that's in tandem to the rate cuts, or is something that might have to happen subsequently or afterwards?
I think my sense is it won't be on the same meeting, but we would like to reduce the reserve requirement by quite a bit because I think it's distorting financial intermediation. But the timing is important. We don't want to do it while we're still hawkish.
Okay. You said it needs to come down substantially. Can you give us a bit more on how much more it could actually be cut?
Well, I have only one vote, but I would say we can reduce it to 5%. Right now it's 9.5%. But
wow. Okay.
That's still one of the highest in the region.
Yes, Governor, you also mentioned about the BSP saying the second half GDP growth would likely slow, due to the previous rate hikes. Are we still seeing the effects of this tightening cycle on the economy? And when do you think that actually starts to fade a bit?
Yes, we are. Our transmission mechanism has long lags, it turns out. The effect peaks at about 1 year after the rate change. So we're still seeing the effects of the October rate hike. We're still seeing it today. So that's why we feel we're still hawkish.
Well, Governor, in addition to those headwinds coming from those rate hikes, what else do you see as a pressing dampener potentially in the second half on GDP growth in the Philippines?
Well, inflation is also affecting growth. It's reducing demand, especially for food. which is also the source of a major source of inflation. So the rate hike in October is still having an effect. We're beginning to see negative a negative output gap. That means it's possible that we're beginning to be tighter than necessary for taming inflation. But these numbers are all imprecise, so we have to use some judgment in deciding whether to ease or not.
Well, that's the big question, obviously. If inflation is still running a little bit higher than trend, that's going to be the main deciding factor then, whether you do cut in August?
Well, inflation, of course, is the main factor, but we also look at output growth. We don't want to unnecessarily reduce output just to tame inflation. So it's a balancing act, as you know, for most central banks. That's the case.
Also, when it comes to the peso, I'm just going back to the currency here. Do you have an outlook of where dollar peso is going to end up this year, and how much weakness are you likely to tolerate before the BSP has to step in?
We don't have a number. We don't have a target for the peso. We're more or less letting the peso float. But we worry about stress, and it hasn't happened yet in the last few months.
Governor Remolona, we have to leave it there, but thank you so much. Eli Remolona there, the governor of the BSP, joining us and telling a little bit more about the need for more triple R cuts. And yes, not too concerned about that weaker peso as they embark on this easing cycle later on this year. Our thanks to the governor. We have some breaking lines crossing here when it comes to Japan. So they basically have left the bond buying amounts unchanged from the last operation. So last time we saw that things were smaller in terms of the amount of bonds purchased. This time they're keeping it at those levels. So you're still seeing a little bit of these yields ticking up higher, particularly in the long end of the curve. It's still at 205 from your 30-year yield. I believe those are still those decade highs. That Japanese 10-year yield, though, we're still hovering around those November highs as we speak here today. And we're watching, of course, what happens with the fix. So that coming through here, no change there, 710.45 this morning, ahead of course, that activity data. We have home prices coming through at the bottom of this hour as well. There you go, a little bit of weakness there on the currency. 722.75. This is what the approach to the open is looking like here today. Your pre-market, it looks to be pretty good in the Hang Seng. We are seeing 302 points to the upside, I believe, here today. A50 futures are still pointing higher. And yes, 233 for your 10-year yield, watching the long end of the curve very closely ahead of that auction today. This is Bloomberg. All right, here are some of the big stories we're tracking for you today. The IMF has criticized the Biden administration's move to aggressively raise tariffs on some Chinese goods, including EVs. The fund says the U.S. economy would benefit more from open trade. The IMF has been stepping up criticism of its biggest and most influential shareholder over surging debt levels, trade restrictions, and even the currency impact of tight Fed policy. Amid the latest tensions, Beijing sold a record amount of Treasury and U.S. agency bonds in the first quarter, totaling an estimated $53.3 billion. Beijing's investments in the U.S. are garnering renewed investor attention amid signs that tensions between the world's largest economies may worsen. Two senior U.S. lawmakers have blasted a Washington-based foundation for secretly accepting money from Huawei. They say the move flies in the face of efforts to keep foreign adversaries from compromising U.S. research, and it follows Bloomberg News reporting that reveals how Huawei, which is blacklisted by the U.S., secretly funded a research competition through the Optica Foundation. Bloomberg has also learned that top HSBC holder Ping An is weighing options to reduce its 8% stake. Sources tell options include further on-market share sales or divesting to a sovereign wealth fund in the Middle East. We're told Ping An board members are currently visiting the Gulf, but it's unclear whether formal talks have started. All right, here is your pre-market here. It looks like we are ending this Hang Seng on a positive note here, a fourth week of gains for that benchmark, and we're well above that 19,500 level here right now. HS Tech catching a bid here. We'll track what goes on with Baidu, what goes on with JD.com after they did in some ways surprise to the upside here when it comes to those earnings as well. H shares are also up about 0.9%. The currency a little bit on the weaker side here today. Take a look at this this golden cross. We've been talking about golden crosses on a lot of these China benchmarks here, but the MSCI is the latest one that we've seen forming that golden cross. And you take a look at how many times this has happened, only 7 times that this golden cross has seen in the MSCI China over the past 10 years. If you take a look at that and what happens afterwards, the index does rise about 3% or more on average 1 month after that golden cross happens. So looks like the technicals are there to see whether we can see more upside in some of these Chinese equities. In terms of analyst actions here today, there's plenty on tap here, given the tech story, given the property story as well. Macquarie coming through here with some new movement here when it comes to Baidu. Those H shares cut to neutral at the firm with a price target of 111. JD.com also from Macquarie, those raised to outperform with a price target of 159. Interesting note from Morgan Stanley here this morning. So they're looking at the likes of Long4 Group, also Poly Developments in particular here today. So still downgrading this sector on weak fundamentals. So they say when it comes to those fundamentals remain highly uncertain in the second half of this year, even though we've seen this massive rally in property stocks. I believe we've recovered about half of the losses since April already. But yes, regulators have turned more dovish, but we think the impact on property sales and home prices remains still highly uncertain, Steve. And I'm going to bring you in now. It seems like that's the case, right? You're seeing more stimulus, but what does this do to actually home prices and actually the supply and demand dynamics?
A lot of people will be watching any kind of lines coming out of this meeting that's going to be held in Beijing today between state banks, the housing ministry, finance officials, state-owned banks, and local government officials about how much this inventory clearing initiative that we have been reporting on, that we have not gotten the details, how much is that going to really help sentiment, or is it going to disappoint? Morgan Stanley in their report saying it might disappoint.
Yeah, I mean, especially they're saying that the scale of funding is in question, right? Yeah. We'll talk a little bit more about that. Stocks to watch here today, Baidu, JD.com. We're watching just overall big tech here, tech, I should say here. There you go, Baidu up some 3%, JD up 1%. The open is next. Welcome back. You're watching the China Show. We're counting down the open of markets, the open of activity data for April. Also, these home prices are coming through any second now here. So it looks to be quite busy on the agenda here today. In particular, when you're watching these bond markets as well, just given that the first kind of batch of ultra-long special bonds are going to be coming to the market here on this Friday morning. But equities are still catching quite a bit here this morning in the Hang Seng. We're up about 0.7% in the pre-market. The tech side of things seems to be driving that this whole week, whether it's Alibaba, whether it's Tencent. This time it's Baidu as well as JD.com, which in some ways actually surprised to the upside with their earnings. Both were a beat when it comes to net income side of things. We'll talk about the revenue side a little bit later when it comes to Baidu, which did come out a little bit more on the weaker side. But you take a look at what we're looking at here today. It looks like we're still set for a fourth week of gains when it comes to Hong Kong. CSI 300, though, I think we're still set to snap out and see one of the first weekly declines in some time now. We're flat when it comes to the Shanghai markets here this morning. We'll see how this plays out there. But the small caps are pretty much flat as well. Some of the big caps are watching like CATL. I mean, you've seen Ping An Insurance catching a slight bit here this morning. Merchants Bank as well. We're watching, of course, very closely the property stocks and whether this rally can continue for another day. But you are seeing, though, commodities are catching a massive bid here. Iron ore is up some 1% in Dalian. Shanghai crude also seeing that. So this commodity story still remains quite strong. We're watching, of course, the long end of those curves, the CGB curves here this morning. So we're up about 1 or 2 basis points for the 10-year, 30-year as well. Yet we're expecting to hear, according to financial news, that those bond yields likely could yield about 2.5% to 3%, which is kind of where those levels are right now. So could be be some solid demand out there for this bond auction here today. You take a look at how the Hong Kong Open is looking like as well. We talked about, basically it's a tech story. It's these property stocks. Morgan Stanley, we just talked about that call about, the fundamentals of this property market are still quite weak. And they said, when it comes to some of these policies on real estate, investors might end up being disappointed by some of them, whether it's the scale of the funding or whether this whole kind of replenish of new homes and the like is actually going to affect the secondary supply of the market as well. There you go, though. You're still seeing Hang Seng up about 0.75%. HS Tech is driving that here. MSCI China, we talked about that golden cross. We're still seeing gains of 1% here this morning. And some of these big cap names still are doing quite well. HSBC, that's the one to watch. We're down some 2%. So Ping An, they're talking about at least considering what to do with that stake that they have with the bank. So that was a scoop that came out yesterday and did also affect the shares in London overnight. You take a look at how these tech shares are doing. So JD.com slightly down the downside here, despite it seems like they were able to at least generate some profits and earnings here amidst this sort of consumer downgrade or so. Baidu, though, there you go. That's the one where you're seeing a bit more surprise to the upside, 3.6%. Revenue was still the slowest in a year, I believe. So it seems like the slowing economy did also overshadow some of the AI sort of earnings and the like here. So that's still, though, but we're still seeing at least able to eke out some profit gains. You take a look at how the property shares, there you go. We're seeing another field day. Like so SIFI Holdings, we're up some 10%. Sino-Ocean also up close to 16%. Country Garden also having that hearing happening, I believe, right now. There you go. You have your new home prices coming through. So we're seeing a decline of 0.58%. That is a deeper sort of contraction that we saw from the previous month. Used home prices also were down 0.94%. Steve, what do you make of this? These drops are faster than what we're seeing.
Yeah, because in March it was a decline of 0.34 in new house prices, and they've now fallen for 11 straight months. 27 out of the past 32 months they have fallen. That's not surprising. That's not a news flash. We know that it's been weak. But again, what it's going to take to turn this sentiment around for buyers? Perhaps we'll get some details coming out of Beijing with the key authorities meeting to discuss this potential inventory clearing plan.
Yeah. For new home prices, that nearly 1% drop month on month is the worst fall we've seen since 2014. So certainly that does go to show things maybe are slowing down once again. Let's talk a little bit more about equity markets and this rally, whether you can chase it or not, or do you need to sell on this bounce? Let's bring in Winnie Wu, Chief Equity Strategist of BofA Securities. So, obviously we've seen 20, 30% gains already. What do you think has changed the most?
I think the first leg of the rally in late April was more driven by global macro, what's happening to AI, what's happening in U.S. macro, what's happening to the Japanese yen. So it was more U.S. long-only position flow buying into the China equity market. But in the past 2-3 weeks, there are more hopes of China policies, especially around properties, around the dividend yield tax cut. So that's continued to fuel the rally. By now, the PE valuation of MSCI China is at 10.6 times. Compared to post-reopening high in January last year, it was 11.7. So back to the post-reopening high, we got 10%, right? But I think to get that 10%, it depends on a lot on the fundamentals, right? So what's the macro data this morning is going to tell us? What's the property measures? Are they going to be, really effective, or is that a case of buy on the hope and sell on the fact? So I think, back to the post-reopening high, 10%, we might see some pullback correction, but hopefully, this time with the flow, with the fundamental, it means that the worst of the market in terms of derating, in terms of fund outflow, is behind us.
Well, I'm going to get you as well. We need to kind of answer the top line question from your latest report. Do you chase this rally or sell the bounce?
So our recommendation is to do the rotation. So first quarter of the year, even first 4 months, the best strategy for China market was the high yield SOEs. by now, especially some of the A-share high-yield SOEs, their yield has already fallen to below 6% because the share prices were up anywhere between 20 to 40% year to date. So we say use the rally to rotate some of these SOEs with falling yield, but in any pullback or correction, we would add quality beta, especially in some of the internet sector.
You recently had a conference in Shenzhen where you mentioned that investor sentiment has clearly turned a little bit more positive. I mean, what are the long-only funds telling you right now? Are they participating in this rally in any way?
As I mentioned, U.S. long-only are probably the first batch of people who drove up the rally. Hong Kong, China long-onlys are a bit more reluctant, partly because they are close to the market, so they are have more skepticisms in terms of the policy effectiveness. When they talk to the corporate, majority of the message is things are stabilizing or marginally improving, but it's not snapping back. So they have more concerns, doubt, questions, and also, with the speed of the market movement, right? When market is up like 20% in less than a month, it's very hard for many long-only to chase. So I would say, in terms of the long-only participation, it's still at quite early stage.
Investor sentiment clearly has picked up when the market is up, the CSI 300 index up 13% since February 1st. That's good. Again, the question still remained around fundamentals. But property, you mentioned it in the beginning one, we're seeing the fundamentals there are not improving. What would you want to hear from any potential meeting that is happening in Beijing right now about property rescue measures and how much that's going to potentially cost the local governments as well as the central government and the banks?
Yeah. So I think fundamentally, there are supply and demand side of the issue. For the demand side, the key is to make property desirable again, right? Because for the past few years, with these properties for living, not for speculation, home prices been falling, and people are not going to buy a depreciating asset, right? So the key is to change the expectation to make people have the confidence on property price that is going to stabilize or even have room for long-term appreciation. Now, that probably need a strong momentum in terms of a package of policies. In the past 2-3 years, we've seen a lot of piecemeal easing, which is not helping, which didn't help, right? So this time, hopefully, we can create enough momentum to make people want to buy property again. And then on the supply side, the destocking measures, I think is a great initiative, but really, like you said, come down to how much funding. Who's going to pay for that?
Right.
Now, if we're hearing that commercial banks providing loans, that's fine, but who's borrowing? Is that some central entity or is that local government LGFV? Because if it's local government LGFV, then I worry that the scale, the speed of execution will still be constrained because we all know the physical constraint and the debt issues of some local governments.
And so when it comes to how you look at stocks, I mean, is it still, you look at it all in one consumption sort of downgrade, or can you actually find and divorce the property story with the rest of the consumption story?
Yeah. So a few weeks ago, we did publish a report on the smart consumer story. So, it's true that property prices going down, which has some negative effect on the on the consumer confidence, right? So people have become more selective in terms of what they are paying, where they are spending the money. There is the consumption downgrade trend, but we also highlight that household overall balance sheet remain quite solid, right? So people have the ability and willingness to pay for products or services that can make them feel good or provide functional value. So you need to have a value proposition, right? Either emotional value, make them feel good, healthcare beauty product, alcohols, right?
Alcohol,
snow sports were super popular last year, right? And that's not a cheap sport, right? Or you provide functional value, right? So online education. People still want to pay, right? Or low sugar drinks, right? Healthy drinks. Otherwise, you provide value for money. That's a consumption downgrade.
Winnie, I'd love to talk the rest of the interview about alcohol and skiing.
Giving emotional value.
I want to go back to property really quick because, again, you asked the kind of overarching rhetorical question, who's going to pay for it? Who's going to take the hit, right? So we also have this auction for this new long-term special bond. A trillion yuan, essentially. It's 186 billion US dollars. Do you see the bulk of that going into their property rescue measures? To take the pressure off the LGFVs that you talked about, the local government financing vehicles, which are, absolutely indebted, a fiscal strain.
Yeah, we certainly hope some of the fund can be used to help with local government, but we don't know, right? Because this 1 trillion was announced in March, and if you look at the scale, it's within the scope. Last year, net issuance of government treasury bond was 4 trillion. So even though it's the first time we're issuing ultra long term, but the 1 trillion in terms of size is actually not particularly big. So is that going to be used to help with the property market? Hopefully, but we don't know.
Yeah.
All right, Winnie, it's great to have you. Have a great weekend. Winnie Wu there, China equity strategist at BofA Securities. Let's talk a bit more about the property side of things and talk about Country Garden now. The defaulted Chinese developer beginning a major legal battle today, and it's going to be squaring off in a Hong Kong court against the creditors seeking the company's liquidation. For more, let's bring in our bond and loan reporter, Loretta Chen. Are we expecting fireworks today? What's going to happen?
Well, unfortunately, I think there won't be any surprises in terms of this hearing possibly getting delayed, adjourned for another date, because we know that the winding up case was filed by a single company, which is listed in Hong Kong King Board, about a $200 million loan. That seems like a single creditor claim that at this point the company can refute by saying it doesn't represent the overall interest of its other creditors, which involves a lot of state-owned banks, institutional investors. Country Garden is advancing these restructuring talks, so I think if the company can prove to show the court that it has made progress in those talks, then this hearing is probably going to delayed, or even if it has a good enough case, even get dismissed.
We've seen more pressure mount, though, on Country Garden. Yes, they defaulted in October, but also they barely missed a default just within the last few days, right? So there's going to be pressure for them to be a viable entity.
Yeah, absolutely. But I think at the same time, if you look at the policy measures onshore, then that's good news for companies like Country Garden with such a big scale. They're benefiting from these measures. If some of these second-tier, third-tier cities where Country Garden has projects, if it's got a whitelisted project, if it's got funding help directly from the local government, that can be a case that you can make in the Hong Kong court to say, here we have some cases for recovery for our investors. They just have to be patient enough.
All right, Loretta, thank you. Loretta Chen there. We'll see and bring you any updates of what we hear from this hearing, whether it does get adjourned or not. Loretta Chen, our bond and loan reporter. We're taking a look when it comes to these markets, and we are still seeing a decent rally. Looks like the onshore market is now also catching up. You take a look at the CSI 300. We're still seeing gains now above water here of about 1/10%. Hong Kong's coming off a little bit, but we're still seeing gains of about 1% or so. HS Tech continues to be what's driving that here today, and we're watching very closely those property stocks. They're still gaining quite a bit. There's a lot of anticipation of the state council meeting, but even the fundamentals we say is still weak, right? That those new home prices and used home prices did drop faster than we saw in March as well. That's not really changing this rally in any way so far. Plenty more ahead. This is Bloomberg.
China and Russia agreed that a political solution to the Ukraine crisis is the right direction. China's stance on this is consistent and clear.
Chinese President Xi Jinping there on what he calls the crisis in Ukraine, and speaking after talks with Russia's Vladimir Putin in Beijing. The two leaders also pledged to intensify cooperation against what they describe as Washington's containment policies. Let's get more now on all this with our Bloomberg Greater China senior executive editor John Liu joining us out of Beijing. John, it seems like we're seeing new signs of cooperation. What really came out of this meeting, you think?
I would say this was an affirmation of the relationship that we already know exists between President Xi and President Putin and between these two countries. As you mentioned, both Moscow and Beijing are chafing under American pressure on various fronts for China. We just had these new tariffs put in place by the Biden administration, and so lots of reasons for the two to work together. They fit together economically. Russia produces energy and commodities. China produces manufactured goods, but they primarily are working together right now. I think the biggest motivation is American pressure.
Hey, John, Steve Engel here. Obviously, it's something that has been in the, the crosshairs of Washington has been the potential of state banks or Chinese banks helping facilitate the trade of dual-use products that potentially could end up on the battlefield in Ukraine. That could elicit further secondary sanctions. What are these two gentlemen, Xi and Putin, potentially doing to avert or to avoid that scenario?
So we've heard very clearly from Washington. Secretary Blinken, when he visited, talked about how Chinese supplies of machine tools and other equipment was a big reason why Russia has been able to keep its war effort going. Obviously, Washington and Europe taking many objections to that. President Putin would like to see this relationship continue, would like to see China ramp up its supplies of goods to the Russian economy. President Xi is trying to balance two things. One, he wants to keep Russia on side. He wants to maintain that relationship. But at the same time, as you talked about, risking sanctions on Chinese banks, on Chinese enterprises, that is not going to help his effort to try and get growth economically back on track in China.
John, thank you. John Liu there, our Greater China Senior Executive Editor, joining us out of Beijing. We also heard from JPMorgan's CEO, Jamie Dimon, saying that the U.S. has to stay engaged with China. Speaking to us at the bank's Global Markets Conference in Paris, Dimon says Washington and Beijing have common interests and are not natural enemies.
So the geopolitical situation is very tense because of Ukraine and Russia, Iran, the terrorist activities in Israel, North Korea, nuclear blackmail. We've never had nuclear blackmail before, and this is, of course, affecting our relationship with China. And, it's going to be hard to have a great relationship with China as the Ukraine war is on. We're kind of on different sides of that, and put Taiwan aside. Having said that, I think it's the right thing for America to fully and deeply engage with China, competitively. Every nation is going to do what's in their own interest for national security. So should America. We should define that fairly and properly. If there's unfair trade, negotiate that or do whatever you need to do. But the engagement is the right thing to do. China is not a natural enemy of the United States. They have a lot of their own problems. So, to me, we could work together as best we can. And then we have common interests: climate, anti-nuclear proliferation, anti-terrorism.
But what does it mean for a bank working in China, actually, given all of this volatility?
They're cautious. I mean, China, if you look at China from a risk-reward basis, it used to be very good. It's not so good anymore because all these things can go wrong. And remember, we bank, I've got the number, but 1,500 multinationals in China. They're not leaving China, so we're going to serve our clients there. We're just much more cognizant that the risk is higher. And I might put Hong Kong in that bucket, too. We kind of look at China, Hong Kong as one at this point from a risk standpoint.
What does the Trump administration mean for the U.S. economy?
I don't know.
Why? Because it's unpredictable, or because we're too soon to actually trying to figure out the policies that he would put in place?
So if you look at history, who was elected president may not necessarily affect the next year. That's kind of like we're a big tanker and that's going to happen. I think the much more important thing is what we do in the geopolitical situation. I've always been quite clear that American leadership is provided to keep the world free and safe for democracy. And that means economic alliances, which includes trade, by the way. I think we should spend more time in trade. It means NATO. It means that Russia should not win in Ukraine. Because if they do, I think it can tear asunder this Western world.
I know you've ruled out being Treasury Secretary. Yeah. Why? What would it take to get you into politics?
I don't think I'm suited for politics. I love my job, and so I'm not sure I want to do something like that. And I can hopefully.
But even if you got the call, would it be hard to say no?
I don't know. Probably yes. I love my job, and I have no interest in leaving and doing anything else. So.
And that was the JPMorgan CEO, Jamie Dimon, speaking to Bloomberg's Francine Lacroix. We got plenty more ahead. Equity markets continuing this rally here this morning. There you go. HSI up 0.7%. HS Tech, we're close to 2% gains here right now. Developers are still catching a bid here this morning. This is Bloomberg. All right, checking markets here today. We're just about 7 minutes away from that activity data, so things could look pretty different. We'll see if things stay the same or not. But take a look at when it comes to Hang Seng. It looks like we are continuing another day of gains here to wrap up this week of gains. I think it's the longest winning streak we've seen for 4 weeks now. Since 2016, if I can remember that right now. My producers can correct me if I'm wrong. But HS Tech is up 1.8%. We'll go through some of those tech earnings in just a little bit as well. But basically, every gauge is up right now. What's not up is basically the CGB market. In just a few hours, we're going to hear more about this bond auction for the 30-year ultra-long bonds here as well. Expected to have some solid demand, but we'll see. Yields ticking a bit higher here this morning ahead of that bond auction. But yes, it comes to this, which is going to be our top story in any minute now. Really, what are we expecting, Steve, and what are you going to be looking out for the most?
Look, it's better than the previous month, obviously.
Yes.
So April's better than March. Again, industrial production, if you look at the manufacturing PMIs, really showed output climbing to the strongest level in more than a year. New export orders rose in back-to-back months for the first time since March 2023. This is an investment and manufacturing-led recovery in the Chinese economy right now. But retail sales is one I'm going to be watching. The consumer, are they back? Not yet.
That's at the top of the next hour. You can follow, of course, those numbers and commentary from our expert editors. T-Live Go is open. We're going to break those numbers coming up next. This is The China Show. Welcome back to the China Show. Here's a look at the CSI 300 this hour. Just a half hour into the session here. We're seeing some modest gains, but really catching up finally here in the last couple of minutes to what we're seeing offshore. There you go. MSCI China continues to see gains of 1%. We talk about the Hang Seng. Basically, we're set for another fourth week of gains here. It looks like things are looking still pretty strong in this Hong Kong rally. You take a look at what's driving it. It's the tech space. And of course, any second now, there you see the countdown clock. That activity data for April is due. So what we're going to see in terms of industrial output, fixed asset investment, retail sales. We just got those new home prices and used home prices, both dropping faster than the previous month here. So at least the property side of things, Steve, still looking quite weak.
Absolutely. The reality is the prices keep on sinking, but the speculation is that the measures will be coming. We have the numbers out. You going to break them or I'll break them? Okay. Industrial production, much better than expected. The survey was for 5.5%. We're getting 6.7%. Obviously, there's some stoking of the factory side of the equation in Chinese economy. Industrial production year over year in April, much better than the expectations, as well as the previous month of 4.5%. Fixed asset urban investment, disappointing a little bit, coming in at 4.2%. We were expecting 4.6%. In March, it was 4.5%. And this is the other side of the coin, retail sales. Oof. Wow, really disappointing. 3.7% was the estimate. We got 2.3%. That tells you the demand side of the equation is not keeping up its end of the bargain.
Yeah, so 2.3%, that's quite a sizable miss. And in fact, we're seeing this is the lowest number we've seen for retail sales since December of 2022. So we're talking about close to these two-year lows when it comes to the consumption side of things. Property investment still remains a negative story. We're down 9.8%. They're also missing estimates. That jobless rate, though, is improving a little bit, though, at 5%. From that 5.2% print as well. So overall, it seems like industrial production was a big beat, but we're seeing a miss when it comes to retail sales and fixed asset investment. Let's bring in our guest, Morgan Stanley's chief China economist, Robin Xing, for more analysis. Your take on these numbers so far, Robin?
Well, growth is stabilizing. That's a good news, but it's very unbalanced. It's largely due to the strength in exports and the manufacturing. So production side is strong, but the domestic consumption side is very weak. As you mentioned, the property and the retail sales, they both missed expectations. So I think growth is stabilizing, but at a very unbalanced pace.
So what happens when new export orders start to weaken as the geopolitical situation intensifies? And what happens when the government also takes its efforts to rein in some of those overcapacity, as they have done in lithium batteries? When will the consumer have to come in and prop up its end of the bargain?
I think, Steve, what you mentioned is exactly the debate right now, how sustainable this export-driven growth could be with all these trade barriers. But it's also interesting when you heard more and more trade barriers, tariff China is addressing this domestic demand issue. Firstly, cash for clunkers for cars. Secondly, digesting the housing inventory. We saw all these news from your news outlet on the State Council meeting today, addressing some of these, ensuring completion, also potentially using some government help to purchase these unsold units. I think it will take a long time until they can come out with a national plan. But in near term, maybe more and more local government will start to launch these smaller scale pilot programs of purchasing some unsold units. So basically, the more external pressures like trade barriers, the more likely China will try to address domestic demand issue, and they have been making a few incremental positive policies. That's good news.
Well, I want to pick up on this potential inventory plan that they're going to be discussing most likely in Beijing. So if they're going to be coming in with the aid of state-owned enterprises and getting loans from the banks, and also have the local governments as well, who are fiscally strained right now, come in and buy up all this excess inventory, which is a lot. There's a lot of it right there. That doesn't really play into the reflation story, because they're going to be buying them on the cheap and then turning it into affordable housing.
Well, in some sense, it's also helping the developers, right? If you can purchase these unsold units, that's going to ease the liquidity pressure for developers. And if they restore their confidence, consumers, home buyers will be willing to buy from these developers. That could mitigate this downward spiral, because you are worried about developers going default. You don't want to buy the units from them. So I do think a government initiative will be helpful. But back to the essential problem, it's a huge funding demand.
How much are you calculating now?
The inventory for primary market right now is about 20 months. In normal year, before pandemic, inventory should be around 12 months. So if China wants to reduce the inventory level to 12 months, they need RMB 3 to 4 trillion to purchase these unsold units. So I think it will take some long way until they can figure out a national plan. But they are making a few positive development, like encouraging local government to start these pilot programs. I think these policy positives will probably reduce the downside risk. So comparing to the beginning of this year, right now what we are saying is China is stabilizing. It's still unbalanced, but they are making some incremental policy to reduce the downside risk. So it's stabilizing at an unbalanced, subdued level, but the downside risk is much smaller than a few months ago.
So you say 3 to 4 trillion yuan to buy up all this excess inventory. That's what, $500 billion US? It's about $500 billion US. And the big question we've been talking to with guests today is who's going to shoulder that? I mean, you're going to have this special ultra-long bond sale that begins today, and the pricing. But again, local government finances are extremely constrained. The state banks have NPLs rising, so that's more shouldering that burden. State-owned enterprises probably don't want to do this, do they?
Exactly. There are still a lot of choking points in this process. They are debating. There is a lot of reluctance because of the so-called moral hazards debates. Who is paying? Which units, which developer you should try to purchase these units? But essentially, as you said, they can do, on the fiscal side, issuing more government bond, widening augmented deficit, or they can use quasi-fiscal measures like the PBOC's relending or PSL program to help these banks to be incentivized to provide this cheap loan for purchasing unsold units. So essentially, it's the central government or central bank. I think it will take some time. And the track record of Politburo has been, if they said, they are starting some proposals. From starting that proposal to coming out with a plan for execution, it usually took 6 to 12 months.
Yeah.
And given how housing is so complex, it may take 12 months, the upper range of that time lag. So maybe by sometime next year, we will see further stabilization of the housing market with the help from central government.
Yeah.
Is there a sense that you have these sort of trade-in programs for homes, full removal of these home purchase requirements? Does that have any sort of impact on the secondary market? I mean, could we just see a wave of supply coming through and adding more pressure on prices, potentially?
I see primary and the secondary as a coherent market. Basically, you have to stabilize confidence. Then you will see the spillover. Once secondary market transaction and price stabilized, it will be easier for developers to sell primary homes. So it's the same thing.
Yeah.
And right now, it's still quite weak confidence level. That's why the government initiatives will be very important here. But having said that, comparing to a few months ago, we do see them making more policy positivities. And that's helping to limit the downside risk for the China's debt deflation problem.
Yeah.
What do you think? I know you're an economist, you're not a stock analyst, but what has the uptick in the stock market helped with, obviously, the outlook for profitability and the outlook for confidence in spending in the corporate China? And does it have legs, do you think?
I mean, on stock market, I think one fundamental question is, okay, China is stabilizing. But how sustainable is this stabilization? And even if it's stabilizing, nominal GDP growth is not in a full-fledged recovery. We are talking about 4.5% nominal GDP growth because CPI, PPI, GDP deflator, these price indicators are still in negative territory. So I guess for everyone, it's like with 4.5% subpar nominal GDP growth, how much upside for China's corporate earning growth? That's the job, our sector analysts are doing every day. But I think that's the question. Like right now, China is stabilizing, but nominal GDP growth is still at a subdued level. But to macroeconomists, I think the good news is back in November, December last year, everyone is concerned China will be falling off the cliff with the entrenched debt deflation problem, local government housing, so they will end up like deflation for a very long time.
Yeah.
But now, stabilizing at 4.5% is actually much better than what people feared 4 or 5 months ago.
What about for the monetary side of things? There seems to be some speculation that the PBOC could cut rates when maybe the ECB starts cutting in the summer. Could they do so? Is that the right timing, or do you think they still have to wait for the Fed maybe later on this year?
We do see room for PBOC to cut both the reserve requirement ratio and the MLF policy rates. But I think the key here is still, can they widen the government deficit, use fiscal policy to stimulate domestic consumption and housing? That's more important than just the monetary easing.
Robin, great to have you, as always. Robin Xing there, Morgan Stanley chief China economist, joining us here on the back of that data as well here as well. You take a look at how markets are doing. It continues to be an up arrow story, I believe. We're watching if there's any sort of market reaction to this sort of data that we got, where we did see, of course, when it comes to the industrial side of things, still looking strong, consumption side still looking weak. The Hang Seng pairing off gains already. We're just up about 0.5%. HS Tech, though, also pairing some of the gains. Shanghai Composite, we're now flat. Now, T-Live Go is open up. If you want more, plenty of analysis from our expert editors and our team breaking down the data for you. You can check that out at T-Live Go. You are looking at live pictures from Beijing as China's economic officials holding that briefing on the back of those April activity numbers here as well. They're just breaking it down in terms of other sort of segments in the economy. One thing that we watched as well was January to April residential property sales was down 31%, which just goes to show the weakness in the property market. Really haven't seen any signs of that turnaround. Perhaps it adds more urgency to the state council meeting that's happening later on today. Why they're bringing together, the financial sector leaders as well as government officials together in this big meeting to discuss how to reinvigorate this market, as well as what are they going to do about the inventory side of things as well. So right now we're also hearing some breaking news when it comes to Country Garden. So as expected, as our Loretta Chen had mentioned before this hearing started, that it now has been adjourned to June 11th. So we have to wait another few weeks for that one, Steve.
Too many issues to resolve in one meeting, obviously. And Loretta said it right. It wouldn't surprise her that this would be adjourned to a later date, as it is.
Yeah, and you look at the markets here right now. Look, there you are seeing a bit of a reaction to this data. So yes, when it comes to industrial production and the like, that was still a standout here. But as Robin Xing from Morgan Stanley just mentioned, it's a two-speed economy, and it looks like it's diverging further given that retail sales print of 2.3%. And so that's why you're seeing HSIs pairing off gains. You're watching the currency here. We're seeing a spike higher when it comes to dollar China. HS Tech, though, still looks pretty strong, but we're already negative when it comes to CSI 300. Shanghai basically has been flat. And there you go. We're only up about 91 points now on the HSI. H shares are also up, but we are pairing some of those gains here as well. We talked about tech, though. That still remains quite strong. You take a look at what's been going on with Alibaba was up some 7% earlier. We're still seeing gains about 6.5%. JD, that was an interesting one because it seems like they defied a little bit of some of the economic concerns of a consumption slowdown and actually doing a little bit better than Alibaba in some ways this week when it comes to those results, but still seeing some downside in the stock. Baidu, though, that one, people were thinking that this was going to be a weak print, but they were still able to eke out some earnings here. But still, revenue was, I think, the slowest in a year or so. But yes, 4% pop for those shares.
Yeah, I think one of the issues with their revenue is that they haven't necessarily, even though they were a first mover advantage in AI in China with ErnieBot, they haven't necessarily been able to capitalize on any revenue growth. And ByteDance has come in with their own AI, generative AI offering called Doubao. So again, it's a competitive market that's not necessarily providing a lot of revenue sharp gains yet. But again, Baidu did beat the first quarter estimates. Yeah. Cost cutting helping there.
Yeah, so I think it was low expectations, and while you're seeing upside surprise on the stock here this morning. Let's talk a little bit more about what else we're seeing when it comes to this equity market in China. And really, is it having some spillover effects in other sorts of markets? And you're sort of seeing that in Japan. So it's giving a fresh impetus to just a host of stocks in Japan that are perhaps exposed to the mainland. And those are also rising here along with their counterparts amid a rebound in the MSCI China Index. Let's bring in our Winnie Wu, Asia Equities reporter, joining us from Tokyo with more. Winnie, this rally in Chinese stocks seems to be spreading now to other parts of Asia. How is it looking in Japan?
Yeah, so we're actually recently seeing a reversal in the earlier trends to buy Japan and sell China, and that's happening amid this Chinese equities rallying on the back of more policy support and cheap valuation, and that's helping some of the stocks in Japan, specifically the ones that have a lot of China exposure, including cosmetic sectors such as Shiseido that actually had some negative impacts from the boycott on the Fukushima water release, and also the industrial sector such as the Yasukawa Electric and Kians. So we really are seeing these sectors and companies rising along with some of the rising along with the broader Chinese market, and that's also shown in some of the earnings presentations that we're looking at, saying that there is some improvement in China, the demand from China, and also the inventory. And we also heard analysts saying that basically the worst for these stocks have already been priced in. But the key point here is that, as we saw in the data just now, the industrial seems to be quite strong. However, the retail is still weak. So the level of recovery from here is something that a lot of analysts will want to watch.
Hey, Winnie, Steve Engel here. Yeah, Shiseido is an interesting company, an example that you met because it should be playing into that overall theme of weaker domestic consumption in China. They get about a quarter of their revenue from China, yet after they reported their latest earnings, the stock's been up about 7% since. So it's kind of going against the trend. The second part of the question is, how do you see the overall trend in the Japanese market doing right now with companies like this that have that exposure to China?
Right. So overall, the Japanese market right now is kind of like in range bound. But most, the biggest reason is because it's really weighed on by these macro factors, whether it's the war going on in the Middle East or the more hawkish tone of the Fed when it comes to cutting rates. So when you look at the fundamentals of Japanese stocks, it still remains very strong. That's cited by big banks from Morgan Stanley, JPMorgan, and also BlackRock is still quite positive when it comes to earnings growth, when it comes to wage growth, or just the corporate governance reform that's going on in Japanese companies. However, I would say one key risk that's still on top of the mind of global investors is the volatility of the currency. Right now, it's at around 156 yen against the dollar, and BlackRock did mention that global investors will have to to see that yen to strengthen to about 150 against the dollar and stabilize around that level for Japanese equities to look attractive to them when it comes to dollar terms returns.
Winnie, thank you. Winnie Xu there, Asia equities reporter, joining us out of Tokyo. We got plenty more ahead. This is Bloomberg. More from our interview with the JPMorgan CEO, Dimon now. He says he's more worried about inflation than markets appear to be. Speaking to us at the bank's Global Markets Conference in Paris, Dimon says significant price pressures are still influencing the U.S. economy, supporting the case for rates to stay higher for longer.
I wouldn't call it turbulence. We've had good, healthy markets for quite a while. They're kind of predicting a soft landing, and you see that in both stock prices, which are kind of high, credit spreads, which are kind of low, markets which are kind of wide open. That's all good. It doesn't tell you what the future is going to be. I mean, I can point a lot of times in history where that was true, and the next year it wasn't true, and so we'll see. I don't pay as much attention to monthly numbers as most people do.
I know. So what do you think the future is for inflation and interest rates?
I'm a little more worried about it. I mean, we've had very big fiscal deficits. And, I think the underlying inflation may not go away the way people expect it to. And I look at the future, like a lot of things we look at are kind of inflationary. The green economy, the remilitarization of the world, the infrastructure requirements, the restructuring of trade, fiscal deficits. So I think there are a lot of inflationary forces in front of us that, may keep it a little bit higher than people expect. So the surprise would be rates are higher, inflation a little bit higher, and maybe that'll slow growth. And obviously, geopolitics is a whole different issue. That could be determinative in what our economy does next year, and we're just not going to know.
But so does that mean you think it's 50-50 whether the Fed cuts or hikes next time around, the next move?
I really don't pay that much attention to that. The Fed will have to follow the data, and I don't know what the data is going to say, but I think they are doing the right thing to be patient right now. See what's going to happen. They may not know for a couple of months.
But no big correction. I mean, if you don't pay that much attention to it, it means you're not worried about anything.
No, I'm worried. I just said stocks are very high, and I think the chance of inflation staying high or rates going up are higher than other people think. So I think the chance, my view is whatever the world is pricing it for a soft landing, I think it's probably half that. I think the chance of something going wrong is higher than people think.
In the U.S. or globally?
Well, I'd say in the U.S., but also that could affect globally, yeah.
And so what does that mean for markets?
They'd be down. And credit spreads would gap out.
So why is the market not pricing that in?
A lot of happy talk.
Where does that happy talk come from?
Low rates, central banks are going to reduce rates. Maybe the geopolitical things disseminate, don't cause problems, and so the future isn't predictable like that. So I'm a student of history. I've watched all the inflection points. If you go back, my dad was a stockbroker. I go back to the booming markets of '72 and the collapse of '74. The healthy markets of '80, the collapse of '82. The '87 market crash, the 1990 real estate crash, and almost all of them were not predicted the year before. So I look at these factors that drive these things. They're not always known. As a company, we prepare for all of it so we can serve all our clients regardless.
But what do you see as the main stress right now? Because if it's geopolitics, we talk about it. It's just not really priced in. Is it distress? Is it something actually going under that you worry about, or just multiple factors coming in at the same time?
No, I think geopolitics could create the main stress that we're worried about in terms of oil and gas prices, trade alliances. But I think the surprise would be higher rates because inflation didn't go down. That inflation has been stubborn, maybe bounces up next year. I think inflation next year may be in the cards. It may have nothing to do with what you're seeing today. So that to me is the surprise. If you had higher rates and God forbid stagflation, you'll see stress in real estate and leveraged companies and some private credit and things like that.
Dimon there, the JPMorgan CEO, speaking to Bloomberg's Francine Lacroix. Take a look when it comes to markets. It seems like that sort of mixed data out of China is really kind of dragging things right now, particularly when it comes to FX. So we're seeing weakness in the currency. Dollar yen, we're at 155 also. So it's also a yen story here after the Bank of Japan left those bond purchase amounts unchanged. Aussie also is lower here this morning. This is Bloomberg. All right, just recapping the big data dump that we just got at the top of the hour. So it continues to be a lopsided economy, as some have described it here. Take a look at the beat that we saw when it comes to industrial output of 6.7%. But you pair that with fixed asset investment down to about 4.2% gains there. Retail sales also missed at 2.3%. That's the lowest print we've seen since 2022. It just goes to show, and the questions of how sustainable this sort of two-track economy can really be, Steve.
Yeah, these numbers don't surprise me one bit. I mean, we already know the consumption trends are quite weak. Nobody wants to catch a falling knife in property. Also, even in cars and other things, you know, retail sales are just the bad side of the coin in the Chinese economy right now.
And those new home prices are actually getting worse in terms of the contractions that we've seen in April. So I think that's what's dragging the markets.
But property's been up. Because on speculation that what they're talking about in Beijing perhaps could come up with some sort of silver bullet or bullets.
The Bloomberg property gauge has basically gone up 50% since the April lows on just pure speculation, right, of what's going to happen in the state council meeting between government officials, financial sector leaders, regulators.
Housing's to be lived in, not speculated on.
Well, yeah, we'll see if we hear any of that sort of language here. You take a look at how the CSI 300 is doing, though. We're back to negative territory here. So that weaker data, I guess, when it comes to retail sales, property, that's really what's dragging things. We were seeing about 300 points to the upside in the Hang Seng. We've basically faded that now. We're just slightly up about 1/5 of 1% right now. But tech, I mean, it's still resilient, though we've paired off some of those gains here as well. But certainly the standouts include Alibaba, Baidu here today. That is lifting that index. In terms of the broader region, what we're seeing in Asia, so I think we're still around those 2-year highs. But you know, take a look at what we've been seeing, the records that were set in Europe, the S&P, the NASDAQ overnight, that also came off. And we kind of didn't see that much more buying activity as well. There's still that sort of higher for longer narrative that's still weighing on maybe risk assets here today. So we're still a bit on the back foot. But HSI, we're still set for a 4th week of gains, mind you. U.S. futures are unchanged. The dollar is slightly catching a bit here, given just the weakness that we're seeing. The renminbi, the yen. Gosh, we're back to 156 levels now. We're getting closer maybe to 160 than 150, Steve, as well.
Yeah, the yen can't seem to get any momentum. As soon as it starts to appreciate, there was some intervention, and then it's weakening again.
Yeah, so BOJ didn't do much when it comes to changing how many bonds they're going to buy. That's what the disappointment lies, I guess. Let's talk about China now, because it's been a busy day, but this is what's upcoming as well. China's first issuance of special ultra-long bonds on Friday is happening, and expected to see some solid demand. Let's bring in our Bloomberg opinion columnist, Shuli Ren. She says the impact of the sale will depend on who buys them and what's the funding meant for. Let's try to tackle those questions. Shuli, she's here with us. So how do you think these funds are going to be used?
Well, the Chinese government has been very vague about this. These special funds, they're kind of like a wire cards. They're not in the fiscal budget or deficit in this case, and you can use them for anything. The last time it was issued, it was 2020. It was clearly for COVID relief. So this time, people are speculating how that 1 trillion yuan is going to be spread around across industries. I mean, if you read the Chinese government's readout, it looks like they use a lot of President Xi Jinping's new jargons, such as new productive forces, high quality economic growth. That makes you think that he's going to put money back into the industrial sector. However, here's the catch. This time they talked about demand. They worried about the still weak domestic demand, and that perhaps is a catchphrase for perhaps helping the housing sector, and that's why the real estate developer stocks have been jumping like crazy, right? People just expect that a big chunk of the 1 trillion yuan will be used for the government to buy unsold homes.
China doesn't need more industrial capacity, does it?
No.
Its biggest problem is property. You mentioned about 2020, the last time they did this special ultra-long bonds, that was for COVID relief. That was the biggest pressing issue.
Yep.
The 2 times before, in 1998, was recapitalizing the state banks, a pressing need ahead of their eventual listings, right? Yep. And then 2007, they topped up the Sovereign Wealth Fund.
Yeah.
So property, I would assume, only 4 times they've issued these bonds in 26 years. Property is the biggest drag.
Yes, and Stephen, you are totally with the global investors thinking. People do think that a big chunk of the money will be used for the government to clear unsold excess inventory. And in fact, the Politburo meeting at the end of April, they talked about that. They talked about digesting unsold housing stock. And that was the first time they used those excess supply language since mid-2016.
Shuli, thank you, Shuli Ren, joining us here, Bloomberg opinion columnist, on, of course, this ultra-long bond sale happening here today. Let's bring in our next guest, and Anitza is Asia head of fixed income research at UPP. She also joins us here in the studios, and it's always great to have you. We're anticipating this bond auction in China. What are you anticipating in terms of demand?
I think the demand will be strong because overall, there's still lacking of like long-dated bonds in China, and most of it is like short data or medium term. So that's why we reckon that the domestic would be happy, to go for the long end to lock in some of the yield as well.
How do you square these two narratives that are going on? That there seems to be a sentiment which could be bullish for these CGBs, that there's going to be more fiscal stimulus or monetary easing by the PBOC, but then you have these warnings from the PBOC talking about buying up these bonds as well.
I think they're just, trying to uphold the yield curve as well, such that, as we expect, there could be more issuance going forward. I think that's an important creating the curve as well as, like creating a technically supportive environment as well. But again, we reckon that, the demand for long-dated bond should be, quite well received in China.
And then just overall for the Chinese credits, is the SOE theme still strong?
In a way, I would say yes, because technically a lot of Chinese investors are still, trying to buy the strategically important SOE. I think people are still looking at quality credits in general in China, like China SOE, China tech names. But then foreign investor participation may be less than before it's sort of like, the property turmoil. But overall, Chinese bids are still very keen in terms of supporting the credits.
Looking broadly, you're saying, Asia still a place to find carry? Right now?
Yeah, that's right. Okay, well, I mean, first of all, I'll look at, what the Fed path would look like. What we think would be sticky inflation was still going forward, but then one data on the core CPI seems to be lower, right? Yeah. But it doesn't really sort of change the trend yet. I think Fed would be patient in terms of, looking forward. So we reckon that there could be only one rate cut in December. And therefore, at the moment, we won't, looking at the fixed income as having capital gain, but rather, I think, you need that for your carry in the portfolio.
Well, that's an interesting point. If you think the rate cut is going to be pushed to December, that's really pushing it towards the end of the year. The Fed, do you think, could go the year without a cut?
Potentially, I would say really data dependent, because at the moment it's very difficult for us to look at the trend. Inflation, I said one data lower, but doesn't mean to be the trend. Yeah. And non-farm payroll number last week was weaker than expected, but then it's again just one number. So we need to see the trend. Potentially, we think December would having one rate cut, but potentially if the inflation still remains sticky, Fed may not cut at all in 2024. So it's still sort of like having different scenario. But we reckon it's still December having the cut.
What does it mean for treasuries?
Put it this way, for the 10 years, at the moment it's around 4.5. Come down from the 5%. The main reason also because FOMC meeting after that, they mentioned about the balance sheet reduction in terms of amount. It's reduced from 60 to 25. Actually supportive to the treasuries itself, especially at 10 years. Now, what we are looking at the moment would be at around 4.5. It's a level that could be supported. And into the summer, we think it could stay around 4.35, 4.5, around that. You see 4.35 is also sort of like a strong resistance level for it to go lower. So, but next year, we reckon the 10 years could, the yield could back up because we worry that there could be more issuance going forward. So we still like short data bond, because of the inverted curve. We will prefer the short end of the U.S. Treasuries.
We like to go around the world. It's the China show, but we can talk about Japan as well. Obviously, the BOJ kind of rising down its longer-term CPI or inflation outlook. But again, everyone's looking for the BOJ to potentially hike. So what does that mean, essentially, for a hiking this year for the BOJ? October, maybe.
Right. Okay. At the moment, seems that BOJ are still sort of optimistic. They can manage the inflation. They lowered the forecast in 2025, 1.7 to 2.1, and average long term will be around 1.5. So meaning still, pretty optimistic, positive. So we reckon potentially 10 basis point cut in October is still on the table. But I think, because the magnitude is so small, I just don't particularly think that would be a big impact.
Or hike?
Hike, sorry.
Hike, yeah.
Yes.
We
always talk
Bloomberg
about cut,
headlines.
now, right? Yeah. So that's right. It should be hike, yeah. So overall, we reckon that the impact should be minimal because the magnitude would be, not substantial.
So 10 basis point hike, is that going to do anything for dollar yen?
Not really. So that's why we reckon that, Japan still would intervene about the movement on the yen. They don't want it to, weaken so quickly. But at the same time, I think fundamentally, the yen, should be at around.
It's interesting because they announced this week that they're going to be buying less bonds. We saw certainly JGB yields move, but not dollar yen. Are we going to see that those two basically be divorced?
I think it's in two different ways going at the moment. A lot of different factors affecting the yen, but JGB would be more by what the central banks would like to do.
We just got these National Bureau of Statistics numbers coming after the data dump in China. CPI expected to recover moderately from low levels, but that doesn't necessarily mean that they're going to be hiking. Obviously, anything from the PBOC is still easing to get this economy going. And CPI is really muted.
Exactly. I think, easing would be the way to go forward. In particular, they are looking for a GDP number of 5%. So I think easing definitely the path they are going. There could be cut in terms of triple R, but I think they would, have a look at the different data going forward first.
What do you make of all this talk of property stimulus? I mean, we've seen junk bonds basically rally to the highest we've seen in 3 years.
Yeah.
Are you participating in any way in the junk bond market?
In a way, okay, yes. Put it this way, there's recent news about they are clearing the inventory, in China, right? Trying to buy some of the properties at discounted prices. But I think the move definitely would have to look at, the details of the plan. What's the impact of that, on the other secondary prices in the property market? We reckon for those who've been defaulted, they would still go for restructuring. There's no doubt about it. Liquidity is pretty tight still in the property market. You see the April sales numbers not good at all. Yeah. But those who, been surviving, put it this way, I think that would definitely help them with the liquidity. But I think, still a story that we need to monitor.
Okay. Anitza, thank you so much. Thanks. Anitza Nip there, Asia Head of Fixed Income Research at UBP, joining us here. And of course, you're looking at those live pictures from Beijing as China's economic officials holding that briefing when it comes to those numbers. And certainly we talked about, right, CPI expected to recover moderately from low levels. Improvement in services demand is what's helping to boost that CPI. And I think that some of the economists that we talked to, Steve, still think that maybe we could still see a positive print on CPI maybe later on this year, but we're still talking low levels.
We're talking low numbers right now for inflation. It is not a primary concern right now of the PBOC.
Yep, they're still saying the economic recovery faces challenges and the uncertainty of external environment also rising as well. We'll have more coming up through when it comes to the National Bureau of Statistics and the like here. We're going to leave it there. If you want to check in more on this conference, go to LiveGo. You can watch from there. You can also find the big diary entries and big stories coming up later on this week. And some of the events you may have missed earlier as well. You can check out those out there. Plenty more ahead. This is Bloomberg. Well, the Philippine Central Bank Governor Eli Remolona says that he wants to see looser liquidity with current policy becoming tighter than necessary. He spoke to us exclusively after the central bank held its key rate, but signaled a readiness to pivot to cuts.
Still hawkish, but less so than before. It may put pressure on the peso, but so far it hasn't. The peso opened at 57.53 this morning. That's only 7 centavos weaker than last night. So far it hasn't really affected the peso.
Okay, it seems like right now 58 seems to be that magic number people kind of bring up about whether the BSP would intervene. How far would you go in defending the currency?
Well, yesterday we didn't intervene at all. We were happy with the movement of the peso, but if there's stress, then we might come in. Stress means large offer sizes, high volatility, and then we might intervene.
Is it a wait-and-see kind of approach right now as well on the possible intervention when we're seeing that maybe the Fed, though, will not cut until December at the earliest, according to some of the expectations? Is this a strong dollar story right now that you're battling against with the peso?
Yes. It's been a strong dollar all along, broadly strong dollar for the past several weeks. So we don't feel obliged to intervene, but we want to keep the market orderly.
Governor, also, we heard some comments from you saying that perhaps some of these maritime incidents off the Philippines in the South China Sea with China have had an impact on the peso.
Yes.
What are you seeing, the direct correlation there?
Well, any incident seems to affect the peso a bit. So far, not so sharply. But recently, none at all. The incidents have not affected the peso.
Okay, Governor, is there a concern in any way of the pass-through of a weaker peso to inflation dynamics now? Is that a concern to you in any way?
The pass-through has been very small because the movements of the peso have been small. But that's not to say that if the peso weakens sharply, the pass-through may be significant. But so far, it's been small. It's been there but small.
What do you think you need to see to warrant that cut in August, Governor Remolona? Are the inflation dynamics, do you think inflation will still remain in target of that 2 to 4%? Also, domestic demand, can that continue to soften, or are there upside risks to both of those scenarios?
There are upside risks to both scenarios, but so far the peso, the inflation rate has been looking good. It's been trending down, and output growth has remained intact. So those are pieces of good news for us, which makes us more confident about possibly easing in the second half of this year.
That was the BSP Governor Eli Remolona. They're speaking exclusively to us here on the China Show. We're taking a look when it comes to these currencies. Obviously, we've been talking about that peso, and we've seen a little bit of recovery in the currency. Perhaps that's why the BSC is breathing a little bit better here these days and being a little bit less hawkish. But there you go. We're still seeing some weakness across the board. But really, it is a weakness across Asia FX here today. You talk about the dollar getting a bit firmer, dollar yen inching ever so closer to 156 levels here right now. The BOJ not doing much in terms of those bond operations here today. The Aussie and renminbi continuing to see that weakness. The renminbi really is a double whammy between the weaker yen, also weaker data, or at least mixed data in terms of the activity data out in April as well. We got plenty more ahead. This is Bloomberg. Here's a look at your China brief this morning, a look at what's making headlines in national newspapers and trending online. So Chinese state media remains focused when it comes to Vladimir Putin, the Russian president's state visit, with the story on the front page of all the major papers. And Xinhua News Agency's main report calls China-Russia ties a fine example of major country relations, saying it's not targeting any third party. Now, Putin's visit comes as both sides prepare to mark the 75th anniversary of diplomatic relations. She says those relations are good for global peace and stability. And Steve, I feel like it's more about an affirmation or reaffirmation of these ties, more than maybe that's something that's a deeper cooperation. Certainly Russia wants that, but I think China just kind of wants to keep the status quo at this point.
Yeah, they don't want to necessarily project any kind of weakness in their no limits partnership at this point, especially at a time when Washington is adding sanctions potentially on China and also, of course, Russia. Let's continue with the geopolitical theme. Yvonne, the Global Times is reporting how a Philippine citizen convoy has been prevented by Chinese forces from sailing to a disputed reef in the South China Sea. The article quotes a source saying the convoy was stopped 50 nautical miles from the Scarborough Shoal, known as Huangyan Dao to the Chinese. But the group behind the mission told Philippine media that they did manage to deliver food and fuel to fishermen on the reef despite being shadowed by Chinese vessels.
Yeah, that issue also trending on Weibo this morning. You take a look at what we've been seeing, what users are commenting on. It seems like it's sort of the same sort of tone. Some saying that it seems that these tensions in the South China Sea are ramping up lately. Some are saying Philippines is provoking China again, but if you hit them once, they will back off. Also, some saying bring some reporters onto their vessels and come back with the story of being bullied by China. That's the Philippines playbook. But yeah, you continue to see that the South China Sea remains still that very area hotspot of where these geopolitical tensions lie. And where does the U.S. fit into all this as well, obviously, is a big question.
Well, the Marcos administration has been a little bit more friendly to the United States, and it's created, obviously, some of this geopolitical tension with Beijing. So. Yep.
In terms of the financial papers, there's a lot of talk about what we're hearing when it comes to the sale of ultra-long bonds, right? So this is the PBOC-backed financial news is citing some analysts saying that, the reasonable range for these bonds is likely going to be 2.5% to 3%. That's just based on long-term expectations for economic growth. So basically signaling demand could be pretty solid here. That's around those levels that we're seeing the 30-year right now. Shanghai Securities News also saying that China's stock exchanges are drafting detailed rules to tighten regulation on programmed trading. Now it says that they include monitoring of, quote, abnormal transactions, as well as oversight of trading activity through the northbound link. There's also a report from the Securities Daily saying that more cities are expected to buy unsold homes and turn them into affordable housing. Now, it says experts see this practice playing a crucial role in destocking the real estate market. It's something that we heard from Robin Xing as well. You're hearing some of these cities, or at least some districts, trying out these sort of programs first on the local level before maybe we'll see something more upscale.
Again, the question is how much of this unsold inventory are they going to come in and possibly buy? I mean, the bill is going to be big. Robin Xing was talking about 3 to 4 trillion yuan. That's $500 billion US dollars. What, 500 billion US dollars.
And they're going to have to issue a lot more bonds than $1 trillion of worth on the terms of these ultra long bonds that comes out here today as well. It really is the story about, I think, of all the things that we're tracking, Steve, today. I think what's really been dragging is really the data, right? I mean, at the end of the day, if the macro picture is still going to look pretty bad, this market cannot continue to rally in some ways, right? You're focusing more on the fundamentals now. And what you're seeing is that, yes, industrial production improved, but the divergence between what you're seeing in the consumption side of things is just getting wider.
Yeah, and the National Bureau of Statistics still going on. The press conference after the data dump, they're saying the economy has continued to pick up and improve. The strong economy could resolve the impact of external shocks. That's to a question about the possibility of U.S. tariffs.
Okay, so they're responding a little bit to that as well. Of course, we're still waiting for any sort of response from Beijing on that. New home prices, this is where I think was the biggest, maybe bigger disappointment in the data today. So we basically saw prices fall for 11 straight months on a month-on-month basis. But even the drop in April was actually steeper than what we saw in the previous month.
Almost to be expected. That's the reality. The speculation is on what's going to come out of that meeting in Beijing.
Ooh, lots of bets on that as well. We're taking a look at markets here on the back foot now. This is Bloomberg.